Welcome to the Deep Dive. We're the show that cuts through the noise of corporate financial reports to get you straight to the insights.
Yep.
Today, we're taking a really close look at Genc Industries, Inc. That's NYSE, American ticker GENC.
That's right. And our source material today is their latest press release titled Genc Industries for Nochnevysledki 2024.
Which, for those who don't speak Czech, just means financial results 2024.
Exactly. It covers their performance for the fiscal year and the fourth quarter, both ending September 30th, 2024.
And our mission, as always, is to pull out the really important stuff for you. The key nuggets, the insights, basically give you a shortcut to understanding what actually matters in all these numbers.
Mm-hmm.
All right, so Genc, let's dig in. What jumps out immediately looking at these results are some interesting shifts.
Yeah.
You know, Genc, they make heavy machinery for highway construction, environmental control equipment, a diversified manufacturer. And at first glance, things look pretty decent on the growth front.
Right. For the full fiscal year 2024, net revenue was up, a healthy 7.7% increase, actually.
So that's $113.2 million, up from $105.1 million in 2023. Good start.
But, and here's the twist, despite selling more, their net income for the full year actually went down slightly. Just a little dip.
Wait. Revenue up, income down. Tell me the numbers.
Net income came in at $14.558 million, which is $1.99 per share, diluted and basic. That's compared to $14.666 million, or $1 per share, back in fiscal 2023.
So not a huge drop, but definitely noticeable when sales are climbing. That's the puzzle for you listening. Revenue up, profit slightly down. We need to figure out what squeezed those earnings.
Exactly. So let's dive into the fiscal year details. One thing on the positive side for their core operations, the gross profit margin was pretty stable year over year.
Okay.
It landed at 27.7% in fiscal 2024. Compare that to 27.6% in 2023. So essentially flat.
Stable margins are generally good.
They are. Although it's worth mentioning, the report notes that the margin in the fourth quarter of 2023 got a bit of a boost. It was from closing out certain equipment sales where they recognized revenue over time. So maybe a slight, let's say, internal accounting timing thing that helped the previous year's Q4 a bit.
Got it. So fairly stable gross margins overall for the year, but that still doesn't explain the dip in net income if revenue was up. My next thought is operating expenses. Did those get out of hand?
Well, it's kind of a mixed bag there, a tale of two trends, really.
Okay.
On one hand, product engineering and development costs actually went down. Not by a lot, but down by about $145,000.
To what level?
Just over $3.3 million in fiscal 24, down from about $3.46 million in 23, and they attribute that to reduced headcount. So maybe some efficiency gains there.
Okay, saving money on the engineering side, that's positive. But what about the other side? SG&A, selling, general, and administrative, that's often a place where costs can creep up.
You absolutely hit the nail on the head there.
Yep.
SG&A expenses surged. No other way to put it.
How much are we?
They jumped by over $2.1 million, rose to $14.3 million in 2024, up from $12.15 million in 2023. That's a significant increase.
Right, and that definitely eats into profits. What drove that increase?
The release points to a few things. Higher trade show expenses, so they were definitely out there promoting more professional fees, and also higher sales commissions, which makes sense given the higher net revenue.
Okay, so that clarifies things. The sales growth was strong, but a big chunk of it got eaten up by those rising SG&A costs.
Exactly, which is why their operating income, despite the higher sales, only saw a very modest increase.
How modest?
It went up to $13.687 million in fiscal 24 from $13.425 million in 23. So barely nudged up because those SG&A costs offset most of the sales gain benefit.
So the core operations were sort of treading water on profitability because of those costs.
Pretty much. But now this is where the story gets really interesting. We need to talk about other income.
The non-operating stuff.
Yes. And it wasn't just a minor factor. It was huge. The company reported a massive increase in net other income for the year. It hit over $7 million in fiscal 2024.
$7 million compared to what the year before?
Compared to just over $5.3 million in 2023. So a really substantial jump.
Wow. Okay, what's in that other income? Where did that extra money come from?
It tells you a lot about their financial position, actually, and the interest rate environment. A big piece was simply interest and dividend income.
From their cash.
Exactly. From their cash balances and fixed income investments. That part alone climbed to $3.435 million in 24, up from $2.1 million in 23. simply because interest rates were higher.
So holding a lot of cash paid off in this environment.
Definitely. And there was another piece, too. Gains on marketable securities, both realized and unrealized.
How much was that?
That grew to $3.62 million in 2024 from $3.24 million a year before, mainly due to market value changes in their fixed income securities as interest rates fluctuated.
Okay, so that other income is a really critical piece. It basically propped up the bottom line significantly when operating income was kind of flat.
It really did. It shows the power of having a strong balance sheet, especially when interest rates rise.
We should definitely come back to that balance sheet strength later. But first, one last thing impacting that final net income number for the year. Taxes. Any change there?
Yes, and quite a notable one. Their effective income tax rate went up. It rose to 29.8% in fiscal 2024. Up from 21.9% in 2023. So that higher tax rate also took a bigger bite out of the pre-tax income.
Right. Okay, so that paints the picture for the full year. Revenue up, core operating profit flat due to SG&A, but rescued by a big jump in investment income, though offset somewhat by higher taxes.
That's a good summary.
Now, what about the most recent trends? Sometimes the last quarter gives you a better feel for the immediate direction. Let's zoom in on Q4 2024.
Okay, so for the fourth quarter specifically, net revenue was pretty much flat compared to Q4 of the previous year, around $20.9 million.
Flat revenue. What about profits in the quarter?
That's where you see a more pronounced squeeze. Gross profit as a percentage of revenue dropped significantly in Q4.
How much?
It fell to 25.6% in Q4 2024, down from 31.7% in Q4 2023.
Whoa, that's a big drop in gross margin for one quarter. Why a difference?
Well, remember how we mentioned Q4 2023 had some boosts? The report says that higher 2023 Q4 margin was due to more high-margin part sales, better absorption meaning their factories ran efficiently, and those equipment sale closeouts we talked about.
Okay, so Q4 23 was unusually strong on the margin front, making the Q4 24 comparison look worse.
That seems to be part of it, yes. But the lower margin in Q4 24 definitely hit the operating income for the quarter hard.
I bet. How far did it fall?
Operating income for Q4 24 was only $1.2 million. That's down from $2.7 million in Q4 23. A pretty steep drop.
And net income for the quarter followed suit, I assume.
It did. Net income for Q4 24 was $1.5 million, down from $3.1 million in Q4 23.
So that Q4 margin pressure is definitely something to watch. Did the other income help out in Q4 as well?
It did, yes. Net non-operating income was still strong in the quarter, $2.5 million in Q4 24 versus $0.9 million in Q4 23. So that investment income continued to be a significant positive factor.
But taxes went up in the quarter, too.
They did. Income tax expense for Q4 24 jumped to $2.3 million compared to only $0.5 million in Q4 23.
Okay, so Q4 definitely shows some margin headwinds emerging, even with the support from investment income. Now let's circle back to that balance sheet you mentioned. It sounds like a real source of strength.
Oh, absolutely. It's quite impressive. Their cash and marketable securities position, it grew significantly.
By how much?
By $14.1 million over the fiscal year. They ended September 30th, 2024 with $115.4 million in cash and securities.
$115 million, up from about $101 million. That's a lot of dry powder.
It really is. And their working capital also looks very healthy. It increased to up to $182.2 million from $164.8 million.
Solid numbers. But you mentioned something else earlier.
Yes. And this is, I think, the real kicker.
Yeah.
The company reports having zero short-term or long-term debt.
Zero debt. Seriously.
Zero debt. In this industry, any industry really, that's incredibly strong. It gives them enormous flexibility. No interest payments, eating into cash flow, less risk. It's a huge advantage.
No kidding. That's a standout feature for you listeners to note. What about their order book? Does that strength translate into future business?
Their backlog looks pretty solid. It was slightly down from the previous year, but still substantial.
What are the numbers?
As of December 1st, 2024, the backlog stood at $56.2 million. That compares to $57.8 million a year earlier on December 1st, 2023.
So still a good chunk of business lined up. Provides some visibility.
Definitely. Enough to keep him busy for a while.
Did the company leadership comment on these results? What's their take?
Yes, the president, Mark Elliott, weighed in. He acknowledged the Q4 margin situation.
What did he say?
He said Q4 revenues were solid, but they did see some softening of margins late in the year. He attributed it to a more competitive marketplace.
Competitive pressure, especially
in aftermarket sales, he mentioned. So parts and service seem to be where the competition is heating up.
Okay. But what about the overall growth, that 7.7% revenue increase for the year?
He framed that very positively, called it an upward trajectory and solid path forward, and he directly linked it to the benefits they're seeing from the IIJA infrastructure funding.
Makes sense. That government spending is a big driver for their industry. What about the outlook?
Elliott sounded pretty optimistic. He pointed to that strong backlog going into fiscal 2025, saying it's expected to carry us well into the first half of the year.
And demand.
He said demand for their products remains steady. So he wrapped up expressing optimism for fiscal 2025, focusing on market growth and delivering quality products.
Okay, so connecting all these dots for you listening.
Yeah.
It's a really nuanced picture, isn't it?
It really is.
On the one hand, you've got GenCore growing sales, clearly benefit from infrastructure spending. They have this incredibly strong financial position, tons of cash, zero debt. That's remarkable.
Huge positives.
But on the other hand, you see these clear signs of competitive pressure hitting their profit margins, particularly in that most recent quarter.
Right. Those SG&A costs rising faster than sales for the full year, and the gross margin dip in Q4. Those are the counterpoints.
And that other income, the investment income, becomes such a key part of the story. It shows how having that fortress balance sheet isn't just about safety. It can actually be an earnings driver itself in the right environment.
Absolutely. It provided a really significant buffer this past year, which leads to an interesting question for you to think about.
So let's wrap this up. What's the big takeaway from our deep dive into GenCore's 2024 results?
Well, I think we've seen a company that's navigating a pretty competitive market, but doing it from a position of remarkable financial strength.
Yeah, they've definitely managed to grow revenue thanks to that infrastructure spending push.
And they've maintained that amazing debt-free status, built up even more cash, and critically, generated significant income just from their investments because of the interest rate environment.
But it's not all smooth sailing. There's definite margin pressure showing up, especially recently in Q4, likely due to that tougher competition the CEO mentioned.
Exactly. The growth came at a cost, particularly in SG&A, and the core operating profitability didn't really keep pace with sales growth over the full year.
Which leads us to our final thought for you today. A provocative question, perhaps?
In an industry like heavy machinery, so fundamental, tied to big infrastructure projects, think about this. How much of a strategic advantage is it for a company like GenCore to generate so much income from its cash and investments while carrying zero debt?
Right. How does that unique financial position maybe allow them to navigate these market challenges differently, or maybe even invest in growth or innovation in ways their competitors, who might be carrying a lot of debt, simply can't?
Does it let them weather storms better, compete more aggressively on price if needed, invest longer term?
Exactly. How does that financial firepower, separate from the actual making and selling of machines, shape their strategy and their future? Something for you to chew on.